Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
And all brokers will have offered different charting platforms. Some of them will be built in, meaning that you can trade directly off of the charts, and some of them you have to trade separately. So your order entry and such is going to be separate from whatever you're using as charting. The FX Options website, actually, you can look up what brokers are offering FX options currently and to see if your broker does offer them. There's a question here on repeating the correction period, so let me go ahead and do that very fast. Basically, we're looking at the Eastern time zone here. So if you're GMT, you're looking at a negative 5-hour difference. So looking at the Eastern time zone from 2 o'clock in the morning, 2, 3, 4, 5, 6, and 7 are major reversal periods. And I like 2 and 3 and 6 as basically some of the places I will get the strongest moves. And then you have 8:30, 9, and 9:30. But really 8:30 is the strongest. You have a lot of news coming out of that time, economic data. And then after the open, you're looking at 15 minutes before and after the hour. So 9:45, 10:15, 10:45, and 11:15. And then it switches heading into the afternoon. So 11 o'clock in the morning Eastern time, and then noon, and then every half an hour into the close. After the close, at 1700, they fall on the hour again, but they're not as strong. So they're not as strong as the ones that start at 2 o'clock in the morning, and they're not as strong as the ones that take place intraday. But after the close, they do fall on the hour again. For those of you that are interested, I go into my building blocks in a lot more detail through this course that I have available online at ToniHansen.com. I do always offer ISE a special, so here's the current special for those of you that are interested. This is a really good question. RQ asks me, how wide are your zones of support or zones around a support or resistance level? Basically, he's asking, is it a certain percentage or what? How do you determine what a zone of support is going to be? And basically, the rule of thumb I use is you can't use percentage levels because it's really going to vary so much when you're looking at different time frames. I mean, something that might be 4 pips on a scalp is nothing if you're looking at it on, say, a weekly time frame. So I'm not looking at things like percentage or an exact price amount. Usually the rule of thumb that I will use is I will look at my major time frame that I identified a setup on. So let's see if I'm mainly trading it off of, say, like a 5-minute time frame. Then I will look at what the average bar is on that 5-minute time frame, and I'll use that as kind of my cushion. So I'm looking at, the small average bars. Let's say, let me draw on here. Actually, let me go back and show you. So let's say we're looking at this upside move here, and we're looking at a breakdown. Well, if this is a 15-minute time frame, it's a 5-minute. But if it were 15-minute, then I'd actually be timing my entry based upon the next smaller time frame. So I would want to look and see what the average bars are of this upside move here, and then I would give it about that much cushion. So I'm guessing it would be about right here as a cushion zone. So on this chart, my stop would be right about here. So I'm basically just kind of looking at the average of a lot of like the recent ranges If you have something where there's a lot of tails on a candlestick, like let's say a lot of back and forth action, wide ranges, really big tails on the candlestick charts, these are going to be higher risk securities to trade, because even when you factor in an added cushion, it's going to be really easy to get whipped out of that position by even just a couple of trades. So usually when I'm looking at securities I'm trading, I'm going to avoid those that have a lot of tails when there's still a lot of overlap from bar to bar in price. So we're looking here. If there's a lot of overlap in bar prices and a lot of tails, then it's going to be a higher risk setup in the first place. And if you do trade those, you want to give them more cushion than you would typically. Something that has fewer tails is going to be lower risk, so I will try to stick to those. Yes, this does apply to currency futures as well, by the way. And it works for longer term. You can apply this to day trading, scalping, investing. I even apply this to my monthly investing. So I do the same thing on a tick chart, which is basically where I'm looking at every single tick or every single trade in the security, and I will use the exact same strategies as I will use as an investment that I'm planning on holding for several years. The correction periods that I quoted are applicable to FX as well as stocks and futures. So they really apply to all three of those markets. And yes, I do actually trade all of these time frames. So I'm not just looking at one particular individual time frame. I actually trade a lot of different securities and a lot of different time frames. It really just depends upon what I'm doing at any particular time. I mean, job-wise, if I'm traveling a lot, or what hours I'm working, and also what's going on in the overall market, because there's certain periods where adding longer-term setups or longer-term trades are more advantageous than others, and there's other periods where I won't add new longer-term setups at all. So I'm really looking at larger trends for timing investments and then dropping down and trading smaller setups in between those opportune times. So I'm really kind of go where the action is. I'm not really stuck trading just one thing or one time frame. Okay, one question is, how many monitors or screens do I trade on? Well, I have technically 6 screens up here, but really there's only 3 of them that I keep charts up or quotes up on. So I basically, I guess you could say 3 monitors, and then I use the other ones for other activities and such that I'm doing throughout the day, like my email and following other things. So basically looking at my screens, though, one of my screens is my scanning screen, and so all of the charts are all tied together, and all of my my list of stocks or my list of securities, basically if I just click on one, it changes all of my charts, it changes all of my quotes. Whereas the other 2 screens I use for watching open positions or watching things that are of interest to me. So if something is forming on, say, a 15-minute time frame, then I might pull up a chart of a 5-minute of the same thing, and then just kind of watch that progression and watch for the building blocks to really line up. So I'm watching those on multiple time frames and multiple screens, but they might not be my active trading window. Michael asks, do I see an advantage to trading Forex instead of just a single currency? You know, I think that a lot of different traders, different types of securities are really going to apply to some traders better than others. Some traders just simply see something on one type of security than they do the other. As far as trading Forex versus the currencies, or versus a single currency, I guess personally, I don't see a huge advantage, but I'm sure that a lot of people would disagree with me. I'm sure a lot of people have their reasons for trading one or the other.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.